Hey everybody, Rob Maurer here, and today we are going to be focusing on Tesla's 10Q filing. This is the filing that happens with the SEC after the earnings report every quarter, and we always get a little bit more detail on Tesla's earnings, particularly this quarter on their capital expenditure plans, stock-based compensation, deferred revenue, some tidbits on margin, production, the energy business, etc. It's a dense report. I spent most of the day going through it, so we'll go through the highlights on that. And then we do have a couple other stories to get to as well, specifically on China exports, some other news out of Shanghai, and a couple other stories, time depending. All right, so first up from the 10Q filing, let's talk about capital expenditures. This is the story that seems to be getting the most attention and headlines today, even though Zach had already mentioned the news that we're going to talk about here on the earnings call. So this should be no surprise to all of us, but in Tesla's 10Q they say, quote, "We currently expect our capital expenditures to be at the high end of our range of $2.5 to $3.5 billion in 2020, and increase to $4.5 to $6 billion in each of the next 2 fiscal years." End quote. This is a significant change from Tesla's previous guidance. For example, in the Q2 10Q filing, Tesla said, quote, "We currently expect our average annual capital expenditures in 2020 and the 2 succeeding fiscal years to be $2.5 billion to $3.5 billion." End quote. So that change here caught a lot of attention today, with quite a few articles out saying that Tesla now plans to spend $12 billion in capital expenditures over the next 2 years. But this information is exactly consistent with what Tesla CFO Zach Kirkhorn said on the Q3 earnings call when he said, quote, "Looking forward to 2021 and 2022, we have revised our expectations for capital spending by $2 billion to $2.5 billion, which we have ample liquidity and expected cash flows to fund." End quote. So for those of you that tuned in to the live stream that I did for that earnings call, we talked about that during the live stream, but just wanted to make sure to address it here again because of the amount of attention today. So even before we got the guidance on the earnings call, I think this should have been expected following Battery Day. Obviously, Tesla has a lot of plans there to spend a lot more money. In a previous episode, we had walked through how Tesla essentially told us that over the next 10 years, they'll need to spend about $93 billion just for battery production, or about $10 billion per year. So even with this guidance, which the midpoint is at about $5.2 billion for the next 2 years, we're going to continue to see this level of capital expenditures increasing, just like we have seen from Tesla historically. If we go back to 2012, Tesla's capital expenditures around that time were about $300 million, peaking back in 2017 around the time of the Model 3 initial production at about $3.5 billion. That's come down over the last couple of years as Tesla has mainly been optimizing that Model 3 production. Then this year ramped up again. We'll probably hit $3.5 billion again, as Tesla said there in the guidance, and then continue along sort of that linear growth that they have been seeing. And I certainly don't expect it to stop there. I wouldn't be surprised if in the future we're looking at capital expenditures per year of maybe $15 billion from Tesla. However, as Zach said on the earnings call, and as Tesla reiterates here in the 10Q, quote, "We expect that the cash we generate from our core operations will generally be sufficient to cover our future capital expenditures and to pay down our near-term debt obligations, although we may choose to seek alternative financing sources." End quote. All right, so next let's talk about stock-based compensation. We talked a lot about this heading into the earnings preview and afterward when we got the results. This obviously drove up Tesla's selling, general, and administrative costs pretty significantly this quarter. Zach on the earnings call said that the stock-based compensation for Elon's compensation package was about $300 million for the quarter. Tesla here in the 10Q says that SG&A expenses increased $292 million Q3 this year versus Q3 last year, while stock-based compensation hitting SG&A increased by $307 million. So if you actually factor out stock-based compensation this quarter, Tesla's other SG&A expenses declined year over year, despite the fact that revenues increased 39%. I know we're working with a lot of numbers here, but just to say that again, total SG&A increased $292 million, stock-based compensation increased $307 million, so more than that entire increase alone. And then the third factor here is that $282 million of that $307 million increase in stock-based compensation expense was from Elon's CEO Performance Award. We've talked a little bit about this, but basically because Tesla is operating at such a high level and the market cap has been so high recently, Tesla's actually accelerating the recognition schedule of some of the tranches of Elon Musk's compensation plan. If you're curious on this plan, I've walked through a lot of the detail in a previous episode, so I'll put a link to that here on screen and in the show notes. But we didn't talk a lot about the schedule of how these things are going to be recognized, so I will take a deeper dive into that this quarter because of these things being recognized ahead of schedule and therefore really suppressing the actual results we see from the operating income line and the earnings per share line. For example, here in the 10Q, Tesla says that because they hit the average market cap milestones of $150 billion and $200 billion, as well as a couple of the operational milestones from an EBITDA perspective, they say that a couple of those tranches were achieved, and quote, therefore, the remaining unamortized expense of $95 million and $118 million associated with the second and third tranches, respectively, which were previously expected to be recognized ratably in future quarters through the first quarter of 2022, as determined on the grant date for the second market capitalization milestone period, and through the first quarter of 2023, as determined on the grant date for the third market capitalization and milestone period, were accelerated into the third quarter of 2020, end quote. This is going to continue to impact future quarters. Tesla in this 10Q here says that the remaining unamortized expense of $122 million associated with the fourth market capitalization milestone period, which was previously expected to be recognized through the third quarter of 2023, will be accelerated into the fourth quarter of 2020. It's really important to understand the results without including these factors. Even though they do impact the financials, there are additional shares here that are granted to cover Elon's compensation, that dilutes other shareholders, that needs to be accounted for, but we need to understand how the business is fundamentally operating, setting that part aside, because number one, these are non-cash costs, so it's not actually impacting Tesla's cash flow, this compensation plan, and then number two, it gives us a better understanding of how Tesla's operational leverage is growing as revenue grows, and that operating leverage is going to have a lot bigger of an impact on future quarters than what Elon Musk's compensation plan does. Aside from the schedule of when these things are recognized, Elon's compensation plan is fixed. Those expenses, at least until he has a new compensation plan maybe someday, are not going to go up, but Tesla's going to continue to grow revenues at 50+% per year and probably operating income at a greater rate than that. So the impact in these quarterly earnings from Elon's compensation is going to continue to become a smaller percentage. Again, we'll come back to that topic, but for now, let's move on to deferred revenue. Tesla this quarter said that deferred revenue related to access to the supercharger network, internet connectivity, and full self-driving features, as well as for future over-the-air software updates, was a deferred $1.73 billion. And of that, quote, we expect to recognize $969 million of revenue in the next 12 months. The remaining balance will be recognized over the various performance periods of the obligations, which is up to the 8-year life of the vehicle, end quote. With the full self-driving beta beginning to roll out, and presumably a wide release targeted for Q4 in the United States, we should see a big chunk of that recognized this quarter, but that kind of sets the ceiling. It's not going to be above $900 million. It's probably not going to be above $500 million, but if we do see the FSD beta go to wide release this quarter, I think we're talking hundreds of millions of dollars rather than tens. The only other point I want to make here on deferred revenue, there was no weird regulatory credit deferrals this quarter. In Q2, Tesla recognized $140 million of deferred regulatory credit revenue from 2019. That balance has now gone to zero, so there was none of that deferred revenue for regulatory credits recognized in Q3, and they also did not accrue any of that deferred revenue to be recognized in future quarters. So pretty simple there, but wanted to point that out. Next here, we got a couple of interesting tidbits on production and logistics. Tesla says, quote, following a quarterly record for vehicle production in the third quarter of 2020, we are focused on further increasing production rates for Model 3 and Model Y in the rest of the year to at least the capacity that we have installed. The next phase of production growth will depend on the construction of Gigafactory Berlin, Gigafactory Texas, and Model Y manufacturing facilities at Gigafactory Shanghai, each of which is progressing as planned for deliveries beginning in 2021. Our goal is to continuously decrease production costs and increase the affordability of our vehicles, end quote. So 3 points there, we'll go in reverse order. Tesla closes that by saying their goal is to increase the affordability of their vehicles. I don't know how many times they have to say that, but let's all keep that in mind for the next time that Tesla lowers the price on their vehicles. In the middle there, they point out that Giga Berlin, Giga Texas, and Model Y Shanghai are all progressing as planned, so nice to see that, and we should expect deliveries from all of those in 2021. That then pairs with the first part of the statement, where Tesla says they are focused on increasing the production rates for Model 3 and Model Y to at least reach the installed capacity. Remember, just because they have the equipment there that can actually produce at a certain rate, doesn't mean that the production rate is going to match that. There may be supply constraints, there may be retooling required, or just time to get through that production ramp to fully utilize the capacity. For Model 3 and for Model Y, Tesla said that they have a current installed production capacity of 500,000 in Fremont and 250,000 in Shanghai. So that's 750,000 or 187,500 Model 3 and Model Y per quarter if they were producing at that full capacity. So a couple points on that. Tesla is saying that they're trying to at least increase production up to that rate. That does not mean that they're going to produce 187,500 vehicles of Model 3 and Model Y this quarter, but that translates to a weekly production rate between those two vehicles of about 14,500. So basically they're trying to get to that weekly rate by the end of the quarter. In Q2, across the entire quarter, they produced about 9,800 on average, but we do know there was some downtime, so the peak production rate would have been higher than that. So we'll keep this in mind for the Q4 production and delivery estimates. And then when Tesla says at least that production rate, I have to imagine they're probably referring to the potential for Model Y to be produced in Shanghai this quarter. I think that has sort of become the expectation of a lot of bulls, not that it's going to be massive in terms of production. Obviously, we've only got 9 to 10 weeks left in the quarter, and it's just going to take time for that to ramp up. Still, pretty interesting wording on that point in my opinion. As for deliveries, Tesla here in the 10Q says, quote, "Our vehicle delivery capability became a bottleneck on our total deliveries as our production increased to a record level, and we are focused on increasing our capacity and efficiency in this area. Situating our factories closer to local markets should mitigate the strain on our deliveries." End quote. So this is important as we head into Q4 and Tesla sets their sights on still delivering 500,000 vehicles for the year. Again, that means more than 181,000 this quarter. And with Tesla trying to ramp up production so much, it's going to be extra challenging to deliver more vehicles than they produce this quarter. Maybe I'm reading a bit too much into this statement here, but at a minimum there, it doesn't seem like Tesla is indicating that they intend to significantly increase their inventory this quarter, even though it already sits at very low levels compared to historicals with just 14 days of inventory on hand. That's never going to be zero because it takes time from when the vehicle is produced to actually get it to the customer and have that customer take delivery. That's where Tesla here is saying that local production is going to help a lot. They said this quarter that local vehicle production was 70% of deliveries compared to under 50% at the beginning of last year. So that'll really help them operate at lower inventory levels. All right, last couple of things here from the 10Q. I thought this one was super interesting. This is on the energy business and the gross margin decline that we saw this year in particular, year over year. Tesla says, quote, "Gross margin for energy generation and storage decreased from 22% to 4% in the 3 months ended September 30th, 2020, as compared to the 3 months ended September 30th, 2019, primarily due to lower gross margins in our solar cash and loan business driven by higher costs from temporary manufacturing underutilization of our solar roof ramp and reduced average selling prices on our solar cash and loan jobs as a result of our low-cost solar strategy." End quote. So usually in these gross margin sections, Tesla will call out if something is offsetting that or if it is also contributing to that lower margin. And Tesla doesn't really say anything about the energy business here, or rather energy storage. So for energy storage, it seems like Tesla's margins have held pretty steady year over year. And really the declining margin here seems to be entirely driven by solar. And I think particularly the solar roof is probably a big drag at this point in time. So as Elon said, next year that'll become a killer product. I think until then, we're probably going to be in these low single-digit margin numbers for the energy business. As for services and others, we've continued to see that margin improve as we had talked about in the earnings recap episodes. Not too much new in the 10Q on that business line, but it did make me go back and look at something from the call, where Zach on the services improved margin said, quote, "We are also seeing financial benefits from improved vehicle reliability across the fleet." End quote. Higher reliability means that fewer people need service from a percentage perspective. That service generally costs Tesla money, especially when it's under warranty. So less is better, and that is what Zach is saying here. I call attention to this because we've talked a lot about Model Y initial quality issues. My argument has been that yes, Tesla can do better there, but also we don't have any data on it, and the Model Y has ramped up more quickly than the Model 3, and also media coverage of Tesla since the Model 3 ramp up has increased very significantly. So of course we're going to hear more stories about it now than we would for the Model 3, but that doesn't actually mean that initial quality is worse. While Tesla is talking from a total fleet perspective here, Tesla does have the data. We don't, and Tesla here is saying that they are seeing improved reliability. That's really all I have to say about that. Last thing here from the 10Q, Tesla did disclose all the details of the capital raise in September. I think they provided this information in the shareholder letter as well, but they said they raised $5.0 billion, of which they netted $4.97 billion after fees from selling 11.1 million shares, indicating an average selling price of $448.77 per share. All right, that finally wraps up the 10Q. To be honest, that took a little bit longer than I thought it would, so we're just going to go through a couple stories here pretty quickly. These are both out of China. Tesla has officially started exporting made-in-China Model 3s over to Europe. Tesla executive Grace Tao shared on her Weibo account a nice shot of a bunch of Model 3s at the port, parked in a formation that spelled out Tesla from an aerial shot right next to the ship as they were getting ready to be loaded. Apparently, this batch will be about 7,000 made-in-China Model 3s. Last story here, hat tip to Jay in Shanghai on Twitter for sharing this out. Shanghai has added some additional restrictions on non-Shanghai license plates. Apparently, without much warning, Shine.cn is reporting that, quote, cars with non-Shanghai plates will not be able to use most of the elevated roads in urban parts of Shanghai from 7 a.m. to 8 p.m. on workdays from November 2nd, Shanghai police announced on Saturday, end quote. Now, my understanding is a bit limited from regional variances here, but I believe there are waiting lists for new license plates to be granted by the government, and those waits can be a long time. I think I've read multiple years in some cases, but I believe that electric vehicles circumvent that list, which adds a nice incentive to purchase an electric vehicle versus an internal combustion engine vehicle. So essentially, further plate-related restrictions could increase that incentive for EVs. Really just the most recent example of the trend that we're always talking about. It's going to become more and more difficult from a regulatory perspective for ICE vehicles, and the shift to EVs is inevitable. All right, we'll close it there for today. As always, thank you for listening. Don't forget to subscribe and sign up for notifications. Make sure you're following me on Twitter at Tesla Podcast, and I'll see you tomorrow for the Tuesday, October 27th episode of Tesla Daily. Thank you.